Welcome to Multnomah Group's second quarter 2026 market commentary. I'm Karen Sanchez, a Senior Manager Research Analyst with the firm. Our first section is on the economy. Economic activity during the first quarter of 2026 reflected an economy that continued to expand, albeit at a moderate pace. First quarter GDP showed that the U.S. economy was growing at an annualized rate of 2.1%, a meaningful improvement from the 0.5% increase recorded in the fourth quarter of 2025. Second quarter GDP data will be released July 30th. Recent data show businesses stockpiling inventories alongside a jump in imports, pushing quarterly GDP lower. Business investment, exports, government spending, and consumer spending all contributed positively to growth. The labor market remained generally resilient during the quarter, although job creation showed signs of cooling. The unemployment rate stood at 4.2%, remaining low by historical standards. Non-farm payrolls increased by 57,000 in June, indicating continued hiring activity, but at a slower pace. Several factors weighed on June job gains, including a 61,000 drop in leisure and hospitality employment that bucked expectations of World Cup-related hiring. Wage growth moderated, with average hourly earnings increasing 3.5% over the 12 months ending in June. Workers are experiencing a decline in purchasing power after years of strong inflation-adjusted wage gains. And while wage gains remained above pre-pandemic norms, the slower pace of growth may indicate that labor market imbalances have gradually eased. The University of Michigan's surveys of consumers measure sentiment, current conditions, and expectations. Consumer sentiment rose in June, about 10% above May, as gas prices moderated. Expected business conditions over the next 5 years surged 16% as consumers' worries over the long-term consequences of the Iran conflict appeared to ease with news of a ceasefire. Still, sentiment remains in unfavorable territory, 13% below the February 2026 reading prior to the start of the Iran conflict, and nearly 20% less than a year ago. The cost of living remains at the forefront of consumers' minds. For the third straight month, over half of consumers spontaneously mentioned high prices are weighing down their personal finances. June inflation remained above the Federal Reserve's long-term target and continued to be closely monitored by policymakers and investors. The Consumer Price Index increased 3.5% over the 12 months ending in June, accelerating from earlier readings. Core CPI, which excludes the more volatile food and energy categories, rose 2.6% over the same period. The divergence between headline and core inflation suggests that recent price pressures have been concentrated in a relatively narrow range of categories rather than broadly across the economy. Inflation rates for many CPI components have improved dramatically since 2022. However, some investors are worried that gasoline prices and tariff costs could keep inflation elevated. Core PCE, the Personal Consumption Expenditures Index, is the Federal Reserve's preferred measure of inflation. The goal of the Federal Reserve has historically been to maintain a 2% target on core PCE. The most recent PCE report showed persistent inflationary pressures. Through May, headline PCE inflation was 4.1% year over year, while core PCE increased 3.4%. June PCE data, which will provide additional insight into inflation trends at the end of the quarter, are scheduled for release on July 30th. Next, we turn to the fixed income markets. Despite the absence of additional policy rate changes, Treasury yields moved higher across much of the curve during the quarter as markets reassessed expectations for future interest rate policy and economic conditions. The increase was most pronounced at the short end of the yield curve, where rates are typically more sensitive to anticipated Federal Reserve actions. The yield on the 2-year U.S. Treasury note rose to 4.14% at quarter end, while yields on 5-year and 10-year Treasuries finished the quarter at 4.19 and 4.44, respectively. Longer-term rates also increased, with the 30-year Treasury yield ending June at 4.91%. The upward movement in Treasury yields contributed to a steeper yield curve relative to cash investments and reflected investor expectations that interest rates may remain elevated for longer than previously anticipated. Higher yields also increased the income available to fixed income investors, although rising rates can create short-term price pressure on existing bonds. Following 3 Federal Reserve rate cuts in late 2025, the Federal Open Market Committee maintained its target federal funds rate range at 3.5% to 3.75% throughout the first half of 2026. The Fed's decision to remain on hold reflected a mixed economic backdrop, with policymakers balancing ongoing inflation concerns against generally stable labor market and economic growth conditions. Economists look towards the futures market to see where the market believes rates are headed. As conflicting economic data came in, the futures market fluctuated during the quarter, and currently the futures market is pricing in a small chance of a cut in the second half of 2026. For the quarter ended June 30th, 2026, fixed income markets produced modestly positive results across all major sectors. The Bloomberg U.S. Aggregate Bond Index, which represents the broad U.S. fixed income market, returned 0.7%. Sector results were broadly positive, with the strongest quarterly gains coming from emerging markets debt, which returned 3.4%, and high yield, which returned 2.4%. Longer duration and credit-sensitive areas also posted positive returns. More interest rate sensitive and higher quality segments generated smaller gains, including treasuries at 0.3%, short government credit at 0.5%, and mortgage-backed securities at 0.6%. Over the 1-year period, returns were also positive across sectors. The bond index returned 3.8% for the year, reflecting a constructive but varied environment for bond investors. The strongest 1-year returns came from emerging markets debt, which gained 8%, followed by high yield at 5.8%. Investment-grade credit and government-related bonds also contributed positively. Treasuries produced a lower but still positive 1-year return of 2.7%, while short government credit returned 3.1%. Overall, fixed income markets delivered positive results for both the quarter and the trailing 1-year period, with risk-oriented sectors generally outperforming the broad market. Turning to the U.S. and international equities markets, equity markets advanced meaningfully in the second quarter of 2026, with the S&P 500 returning 15.2% for the quarter. The strong quarterly result helped lift the index's trailing 1-year return to 22.3%, reflecting continued positive performance despite the intra-period volatility noted during the quarter. Sector performance was broadly positive but notably uneven. Information technology was the clear leader, rising 31.8% during the quarter and 37.5% over the 1-year period, substantially outpacing the broader S&P 500. Industrials also delivered a strong quarterly return at 14.9%, while several cyclical and defensive sectors posted more modest gains. At the other end of the spectrum, energy and utilities were the only sectors in negative territory for the quarter, declining 13.4% and 0.5% respectively. Energy's quarterly decline contrasted with its stronger one-year return of 29%, while utilities remained positive over the one-year period with a 14.2% return. Across equity style and capitalization segments, small cap stocks posted the strongest quarterly returns. Small growth led all asset classes with a 25.7% quarterly return, followed by small blend at 21.5% and small value at 17.2%. Over the one-year period, small cap value-oriented equities were especially strong, with small value returning 43%. Large cap equities also delivered solid results during the quarter, though leadership varied by style. Large growth returned 16.7%, slightly ahead of large blend and large value. For the trailing one-year period, large value led the large cap style categories with a 27.1% return. Mid-cap equities generated positive but comparatively weaker quarterly results. Mid-value trailed all style and cap categories with a 13.4% quarterly return. Over the one-year period, mid-growth lagged meaningfully with a 6.2% return. Overall, the second quarter was characterized by strong equity market gains, with leadership concentrated in information technology and small cap stocks. While the S&P 500 posted a robust quarterly advance, return patterns beneath the surface were mixed, with wide dispersion across sectors and style cap segments. International equity markets advanced broadly during the second quarter of 2026, with particularly strong performance from emerging markets. Developed international markets posted a solid gain of 10.5%, though they trailed U.S. equities for the period. Emerging markets were notably stronger, rising 24.1% for the period. Performance over the trailing one-year period reflected a similar pattern. U.S. equities returned 22.8% for the year, modestly ahead of developed international markets, which returned 21.6%. Emerging markets substantially outpaced both developed international and U.S. equities, advancing 44.2% over the same period. Regional results were mixed, but generally positive. EM Asia was the clear leader, gaining 30.3% in the second quarter and 49.4% over the trailing one-year period. Japan also delivered strong results, rising 14.2% for the quarter and 29.5% over the one-year period. EM Latin America was the only region to decline during the second quarter, falling 3.4%, although it remained strongly positive over the trailing year with a return of 32.4%. Overall, the second quarter was favorable for international equities, with emerging markets providing the strongest contribution across both the latest quarter and one-year periods. While developed international markets participated in the broader equity market rally, they lagged U.S. equities over both timeframes. Finally, we turn to our market outlook. Financial markets are adapting to an evolving monetary policy environment following the appointment of Federal Reserve Chairman Kevin Warsh. While the Federal Open Market Committee's latest projections showed policymakers nearly evenly divided on the future direction of interest rates through the remainder of 2026 and into 2027, one of Chairman Warsh's first policy changes was the removal of forward guidance from Federal Reserve statements. As a result, investors have less clarity regarding which economic indicators may have the greatest influence on future policy decisions. This shift has increased the importance of incoming economic data and may contribute to periods of heightened market volatility as investors reassess expectations for inflation, growth, employment, and future interest rate policy. The artificial intelligence investment theme remains an important driver of market returns, but market sentiment appears to be evolving. During the early stages of the AI cycle, the market broadly rewarded companies with direct AI exposure, particularly large-cap technology firms that announced significant investments in AI infrastructure, computing capacity, and related technologies. More recently, however, returns have begun to diverge as investors increasingly focus on whether these substantial expenditures can generate meaningful long-term earnings growth. Rather than rewarding AI exposure alone, markets appear to be placing greater emphasis on identifying which companies are most likely to translate AI investments into improved productivity, higher profitability, and sustainable competitive advantages. The strong performance of small growth stocks during the quarter may reflect a broadening opportunity set as investors look beyond the largest technology companies towards firms that could benefit indirectly from widespread adoption of AI tools and automation. Another emerging theme is the anticipated return of large private companies to the public equity markets. Several privately held companies with valuations comparable to some of the largest publicly traded firms are expected to pursue IPOs in the coming quarters. Their size has prompted index providers to reevaluate long-standing index construction and eligibility rules to determine how quickly newly public companies should be incorporated into major benchmarks. In response, several index providers have announced accelerated inclusion frameworks that could allow qualifying companies to enter broad market indexes within days of their public debut, rather than waiting for traditional quarterly or annual reconstitution schedules. This change could increase the speed with which capital flows into newly listed companies and may influence trading activity immediately following future IPOs. SpaceX's June 2026 public offering provided an early example of these dynamics. Although the company entered the market with an estimated valuation of approximately $1.8 trillion, only a relatively small portion of shares was made available for public trading. Because most broad market indexes weight constituents based on their publicly available share count, known as free float, SpaceX's initial representation in major indices was considerably smaller than its total market capitalization might suggest. This highlights an important distinction between a company's overall value and its investable weight within passive investment vehicles. As long as equity market conditions remain supportive, additional large private companies may seek access to public markets in the coming year, potentially creating new opportunities. This closes our quarterly market commentary for the second quarter of 2026. Thank you for listening.